Recession or no recession, many Americans are feeling the pinch. I'm Sharla Jessop, president of Smedley Financial, and today my guest and colleague, Parker Thompson, is going to give us an update on the numbers that may be impacting most Americans. Welcome to the SFS Power Up Wealth podcast, where we provide impactful insight and expert opinions on timeless financial principles and timely investment topics, preparing you to make smarter decisions with your money. Parker, thank you for joining me today.
It's a pleasure.
Parker Thompson is part of our wealth management team. He holds a CFP designation and works with clients in helping develop plans for the future. Parker, you have written an article in Money Moxie, which is a by the numbers update. Let's just talk through it and talk about some of these numbers that are impacting so many Americans.
Yeah, I think it's exciting to kind of look at the economy and what's happening, trends that we hear about, not just as headlines and in the news, but by the numbers, right? Statistics can sometimes be misleading, but they can also be very informative in the way that we look and the way that we feel about our financial situation.
One of the numbers that caught my attention was the average cost to raise a child. Talk to us a little bit about that.
When I looked at the numbers here, and we've seen this cost go up and it's been in the headlines, but the estimated average dollar amount was $310,000, just over that. That may not mean a whole lot, but when you look at it in contrast to what it was back in 2017, it was just over $230,000. So what they calculate from one study to another over the course of 5-6 years, we have grown, almost $100,000 in cost just to raise one child. They say from age 0 to 17, so from when they're born to age 17, what it costs to raise them.
That doesn't even include any additional education for, college, university. None of that is included.
Right. 17 gets them to graduation or to high school, right? If you're wanting to fund education, that's on top of that. If you're wanting to have them live with you to save on costs of rent, that doesn't include those costs either after high school.
Speaking of the costs of rent, also household costs have significantly increased.
Right. So that's a part of the study is that, okay, how much does it cost to have enough bedrooms to house that child and to let them live, in the house up until age 17? Because house prices and renting prices have gone up so much. That's why this number, that's obviously a huge part of inflation. It's also a huge part of this number in this calculation.
More and more expensive to raise children.
Yeah,
or to raise.
It's all part
of it. Not a child.
Right, one child, yeah.
Yes.
You start talking, okay, what if we want to have 2 or 3, 4 children?
Yeah, it's a big expense.
It is.
So talk to us also, another number is the housing, what's happening in our housing market, not just in Utah where we're making this recording, but across the U.S.
We know, and what we've heard from, the studies that come out, that the housing affordability is at all-time low. So what that means, normally we're used to inflation charts that go up and to the right, showing that there's more and more inflation, things are more and more expensive. This housing affordability is going down and to the right, which to some people would say that's a good sign, but it's not. It's the affordability of housing. It's not the prices. The prices of the homes have gone up and to the right, up over time. That just means that the affordability, so in relation to the wages that we are earning, the salaries that we have in our jobs, housing is outpacing those raises that we're getting at our jobs. Essentially, the end all be all is that housing is just not as affordable. It is at all-time lows for the last, I want to say, 2 or 3 decades is where this chart goes back to.
Yeah, that's a big impact, especially when we think of the younger people, younger generations who are trying to live that American dream where they get into a home and have home ownership. For many of them, they don't even think it's going to be a possibility.
Right. We grew up with our parents and our grandparents that bought houses, after they got married, a few years after they got married, and were able to raise their families in those starter homes, then move to better homes. And a lot of those younger generations are thinking it's not even possible for me to get into a house until I'm until I'm middle-aged and have a set job that is finally able to pay the bills for that home, that mortgage cost.
Thank goodness everything is cyclical and things will cycle back again for some of those younger people.
Right. That is the home. That is the hope that will correct itself or at least adjust so that things look a little bit more peachy as far as affordability in the housing market. One of the things that I noted is because the ultimate, I won't say the argument, but the counter argument to that is that, okay, well, the generation now today has not had to live in a high interest rate environment. We may think it's high at 6, 7, 8%, but we haven't seen the 12 or 13% upwards to 17 or 18% that was seen in the 70s and 80s. The data that is behind that is that even when those interest rates were higher, the home prices were so much lower. And I know we've said that a lot on this podcast, but to put it in perspective, the average historical home price compared to the median income, right, where we get this affordability index, the average one over time has been 5 times your salary. So you take your salary, you times it by 5, and that's where you get the average home that you can afford. You're right, the average median home price at that time. Back in the 70s or 80s were those higher interest rates, but you have to realize that you only had to buy a home that was 3 or 4 times your salary. Whereas nowadays we're getting close to 8 times today, 8 times what our salary is to afford a home. So you're now having to extend a lot more than what you're earning in your salary to get there. So yes, interest rates are at lower points than they have been back in those decades, but we are vastly outpacing what we're earning as far as stretching to get a home.
And wisely enough, many young people are not willing to jump into those big mortgages and become house poor, be slave to their house payment.
There are some that are doing it. It's scary. As financial advisors, we look at that and say that we don't really like those trends. We'd urge people not to do that. There are people who are in a position to do that, and that's fine. If a home is affordable at any point, we say go for it. But if people are overextending themselves and deciding to go in and just say, well, things are cyclical. Eventually we'll be able to refinance, or eventually we'll make more. That could be true, but eventually that home could be unaffordable for most of their life, and they could be house poor. They could be not being able to save in other places in their life, like for retirement.
That takes some of the enjoyability away.
It's not so much, an enjoyable place to have enough rooms for your family in a backyard if you are living on rice and beans the whole time.
Right. Most of us start out there. We don't want to end at the same place.
Right.
So talk to us a little bit about HELOC loans too, because, many people, especially during the pandemic and interest rates were so low, we saw many HELOC loans, which are typically variable. Talk to us a little bit about that.
I think it was popular when the rates were at 3, 4, 5%. I think it was popular because you realized that you could get out of the just appreciation of your home, you could appreciate more than what your HELOC was paying in interest, or what you were paying in interest to your HELOC. Nowadays, with those variable rates, they've gone up to 9%. In some places, they're offering over 10%. It's very hard to have your home or your asset that you're purchasing with that HELOC appreciate that much annually year over year and paying off that interest if you look at it that way. To me, it's very hard to see even an interest rate that high and to think, okay, I'm going to loan someone money at a 9 or 10% rate. That just scares me as a financial advisor. There are some situations where someone is actually improving their home with that HELOC, but a lot of the times we're seeing people pull out HELOCs for other expenses in life, not just for the home. And, for the toys, for a new car, for a boat, some toys that may not be necessary. Those are the situations that frighten me a little bit.
Understandably. We were talking about overall inflation, and it goes way beyond just raising your kids and the price of your home, but just, living. You were talking about eating at McDonald's, which has been in the news quite a bit lately. Talk to us about that.
Yeah, there was a social media wildfire that got started based off of a Big Mac meal up in Connecticut. There's a city, Connecticut, that was offering a Big Mac meal for $18. And there was a social media wildfire. It went viral, and a lot of people were up in arms about it because it's McDonald's, typically a very affordable, right, family-friendly restaurant for those who are working class or lower class. But to have an $18 Big Mac meal for just a Big Mac, to them was asinine. And so they obviously backed off that once there was the social media wildfire, but it just proves to us today that inflation's a real thing, that what we thought used to be an affordable McDonald's with a dollar menu and where we could take our kids to eat cheaply is very different today based on just cost of goods and how everything is increased.
That is a lot to do with the impact of inflation. We're seeing it not just at McDonald's, but everywhere.
Overall, one of the good things the economy is showing right now, even back when I wrote this article in the beginning of the summer, as opposed to now we're in late summer, we are seeing that inflation is coming down slowly, right? It's still sticking. There's still some areas. We obviously don't want to see deflation. We don't want to see negative prices because that means that the economy would be stagnant or not growing. But we haven't seen those high prices go away. They've just stuck. And year over year, they haven't increased as much. That's why we're seeing inflation going down, and that's a positive thing. But we're still feeling the pinch. Like you said, these American households, families are still feeling that pinch of things costing a lot more than they used to.
And because of that, when you are still need to spend money and it's beyond what your budget is, oftentimes people tend to go to credit cards. Talk to us a little bit about what's happening with credit card debt.
One of the things that economists like to look at as far as is it a recession, is it not, is the delinquency rates on certain debts. The number one debt that they look at being credit cards, because typically credit cards are indicative of we have now wasted our savings. We have wasted all the money that we have in the bank. We have to now lean on credit cards to afford life. This could go one way or the other. There's not a certain historical rate that we're looking at that indicates a recession, but we just noticed that card balances that are 90 plus days delinquent, so you're over 3 months late on your payments, are climbing over 10% for credit cards. So not a good sign for consumers, obviously. We would like to have that as low as possible. Some other debts that people are defaulting on, or not quite defaulting on, but they're just delinquent on, is auto loans, obviously, because those are high interest rates, and other debts. Surprisingly, with the high rates that mortgages and HELOCs and other things are at, those have stayed pretty low. So there's kind of a story of two tales there. There are people who are going into consumer debt and they're delinquent on that debt, but on their home and housing debt, they're doing okay. They're keeping up with it for the most part.
Which feels daunting, but that's a good sign if they're able to just keep up. If people can just manage the excess spending, I think it puts them in a much better position. The numbers would tell us that.
Yeah, I think it's a good sign for now that people are keeping up somewhat. It is obviously foretelling that if people continue to have more consumer debt and cannot control it, that eventually leads into they have to pull out of, whatever mortgage or HELOCs that they're into. They're not able to pay those bills. And so eventually people start to eke into those debt levels, and those things start to become delinquent or default. I mean, this is not a prediction one way or the other, but just something that we watch because we worry about the health of the economy.
Right. And the health of our clients and of individuals. One of the other things you said was overall household debt is increasing, which is a little bit frightening in a tight economy.
The number that we usually concentrate on, or that we have for the past few months, is government debt. We don't always look at consumer debt. The total consumer debt out there is over $17 trillion. It's very hard for us to wrap our mind around that. Again, that number doesn't mean anything unless it's compared with prior years or prior number. Back in Q1 of 2021, that number was sitting at just over $14 trillion. So if you think about that, just in the space of 3 or 4 years, we've climbed another, $3-4 trillion in consumer debt. Again, part of that just to the massive hysteria around getting into a house that happened after 2020. You could maybe attribute a lot of it to that. But so total debt levels is something we look at, and just making sure that our clients specifically are staying out of the certain kinds of debts that worry us.
And I know the market is moving all the time. And so any information we give about the market is outdated tomorrow. It's
Right.
outdated before we even finish recording the podcast. But as of the date that you had written the article, talk to us a little bit about the numbers and some of the trends we see.
At the time that writing this, again, early summer, the economy was doing great. The markets were going up. There was still talk of a potential recession, as there is today. As of right now, the markets are just defying odds, and they're melting upwards, is what we like to use as far as terminology goes. At that time, you had I'll throw a few numbers at you. You had the S&P 500 that was up 11%. You had the NASDAQ that was up 13%. The Dow was up just 2%, and bonds were actually negative 2%. Now, this was as of beginning of June this year. Let me take you on the roller coaster ride that has happened since then. Those numbers, the NASDAQ went from 13, climbed to 25, up 25%, went down to 9%, and is now back up to 20%. And we're recording this as of middle of August. The S&P 500 went from 11, went up to 18%, went down to, plus 9% for the year, and then is now at 18% again on the year as of today. So you can kind of see the roller coaster that we've gone on, and bonds has turned positive, 1.5% for the year. Maybe this is not necessarily the podcast to talk about volatility, but it just shows you kind of the ups and downs of what can happen in the market in a year. But so far, the market just seems to be defying odds, like I said, and proving people wrong as far as recession, or it could be foretelling of a larger drop like we've just experienced.
Well, in order to know that, we'll have to update the numbers again another time.
Right. There's not too much value in looking at just kind of the ups and downs of the market. That's obviously why we tell our clients that the market is a very risky thing. We try to diversify as much as possible to mitigate some of those risks. But it is good to see that the U.S. economy and stocks and the companies in those that represent those stocks are doing well and that they're still profiting.
And over time, if you keep a long-term perspective and we don't worry about the ups and downs in the last 2 months or any short period of time, and we keep our eye on the long-term goals, we'll come out ahead.
Yeah, the averages work out a lot better when you look 5, 10, 20 years in the future.
Great. Parker, thank you so much.
Appreciate you indulging all the numbers and percentages.
Thank you for joining the Power Up Wealth podcast. Smedley Financial is located at 102 South, 200 East, Suite 100 in Salt Lake City, Utah, 84111. Call us today at 800-748-4788. You can also find us on the web at smedleyfinancial.com, Facebook, Instagram, Twitter, and LinkedIn. The views expressed are Smedley Financial's and should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should only be relied upon when coordinated with individual professional advice.
Securities offered through Osaic Wealth, Inc., member FINRA SIPC. Investment advisory services offered through Smedley Financial Services, Inc. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.